Hello, everyone, and welcome to Core Training. This is the execution portion for the Pivot Boss Masters Core Training section, and in this training, we're going to deal specifically with advanced trade management. And advanced trade management is just taking our core trade management techniques and kind of going a bit beyond them. So, with our core trade management techniques that we learned before, we talked specifically about the idea of trade management, risk management, and then also the types of core scaling techniques that we use, like the 11 scaling technique or the 211, for example. And those are techniques that are designed to have you executing trades more so mechanically or like a robot automatically, so that as soon as you see that, that trigger you're looking for to enter a trade, you pull the trigger and then you allow your trade management to just work its way out. And that's basically what our core trade management scaling techniques are designed to do. Now, with advanced trade management, what we're going to be talking about is learning to understand when to deviate from that plan a little bit and provide more of an active trade management approach. So for the most part, this active trade management is going to be something that we talk about with regards to a lot of our trades as well. For the most part, most of the trades will still be very mechanical with those core trade management techniques that we've talked about before. But with the advanced trade management, it's more about understanding when to deviate a little bit and then knowing when to use these creative trade management techniques that we'll be learning about. So let's go ahead and get started with advanced trade management. So advanced trade management is about your ability to actively and expertly execute your bias using a variety of trade management and risk mitigation techniques, while always knowing your theoretical average entry price for a given position. And that pretty much sums it up really, really nicely, because advanced trade management is nothing more than, in my opinion, an active trade management approach. And it takes a little bit of experience to begin to understand when to apply an approach like this and when to stay more or less static and stay with your current static mechanical approach to managing trades, because sometimes there are certain markets where you need to engage that position a little differently, perhaps more actively defending trades or more actively adding to scales, those types of things. Maybe more actively building a larger position because you foresee a larger move coming. So all of those various approaches kind of falls under the umbrella of active trade management, and that's all part of the advanced trade management. It's basically going beyond our static 11 scaling technique, for example, and then knowing when to deviate from that technique and add to it because it's a great winner, or knowing when to perhaps build a larger position, again, like I said, and knowing how to build that larger position. So there's certain times in the market where a certain scenario arises, and you may not have to trade that scenario all the time, but when that scenario arises, you may have to use a creative trade management technique to either enter that trade or to exit that trade. And that's what we're going to be talking about here in this section. So advanced trade management is active trade management. And number one, it says here, knowing when to apply a more active trade management approach can be very, very crucial. So you have to know when to apply that active trade management approach. Again, for the most part, for most of us, it's safest to stick with the same basic approach that we usually use. Stick to 11. Stick to the 21 scaling technique. Stick to the 111 or the 211. But when things are good and you're making money based off of that trade, perhaps it may be time to add to that trade, right? If you've already booked prior profits, you have to know how to properly defend a trade, or you have to know how to scale into a trade if you're not feeling that the market is showing signs that it's going to reverse at a certain level. You may want to put a tester type of trade in there where you're only entering a smaller portion of that size, and then if that trade works out, you're adding to it. So all these various techniques, again, as I mentioned, fall under that advanced trade management umbrella, and we'll be talking more about those. But again, number one is knowing when to apply this active trade management technique, I think, or trade management approach, I think is very important, because I would say 90 to 95% of your trades should still be kind of a static form of trade management where it's just mechanically going through that trade management that we talk about all the time. So number two, know how to deploy creative trade management techniques. So in order to build positions or squeeze more profit potential from a great move, you must have a creative mix of techniques at your disposal so that you can deploy these techniques under the right scenarios. Practice these techniques so they become second nature when you're ready to use them. And so, again, as I mentioned before, you're not always going to have to deploy these types of creative techniques, scaling into a trade or scaling out, in a certain way, or building a position or flipping a position. All of these are very rare type of techniques, but there are certain scenarios where it's appropriate to deploy this type of technique, and you have to be able to know how to do it flawlessly when the time comes. So that's why you have to be able to practice these techniques. Even if you're not actively using them, you have to know what you're doing when it's ready and time to go. So number three here, know your theoretical average entry price. The Theo average, as it's called, is the break-even price for a given position after executing a series of scales and booking partial profits. And so knowing this price is important for many reasons, including risk management purposes, building long-term positions, or knowing whether to add or remove scales. So the theoretical average entry price is just a fantastic price. And I think Futures Trader 71 was really one who on Twitter was really pounding the idea of a theoretical average entry and actually built in that formula, if you will, or calculation into his Stage 5 platform, right? So this is a very important price, and this is something that I've gravitated to as well many years ago just because I scaled so much in my positions. And remember, I talked about a long time ago when I switched from trailing stops and, kind of an unruly trade management approach, and then I changed and shifted to an 11 scaling technique where I finally said, you know what, I'm going to scale, and I'm going to do it systematically for every trade. I went 3 straight weeks without a loser. Remember I said that? That was immediate results right away. Well, knowing your theoretical average entry came from that, because after I was scaling, I was finding that, oh, you know what, my break even isn't at the entry anymore where it used to be, because I've just booked some profits, and now my break even is actually beyond my entry somewhere way back, right? So that's one thing about theoretical average entry, is that after you book some profits in a trade, now the market has to go farther against you just to get you out at break even. And that's kind of the luxury that you create by booking partial profits, by scaling as price moves in your favor. And you're also reducing risk. So theoretical average entry price, nothing more than the break-even price for a given position, but after a series of scales that have been executed to book partial profits. So again, if I were to kind of demonstrate this just really, really quickly here, say you have a level right here, and you bounce off this level here, okay? And say you get in on a retest. This is your entry. Now that's your entry, right? And then say you have a stop right here. There's your stop. And you're risking, say, 2 points. So that's a 2-point stop right there. So when price comes up to a T1 target, and that's 2 points away, and price hits that target, you just made +2 here, right? And so if you scale, say, half of that position, now down here where you had your original stop, that's now your break-even price. Whereas before, when you were into the trade, your break-even was your entry, right? So your break-even was there, but as soon as you scaled at T1, your theoretical average entry dropped from the entry down to where your stop is now, right? And so you moved your theoretical average entry from here to here. Now say price was to continue higher and you took another quarter off the trade somewhere up here. Now whatever you made on that quarter trade, again, you can then move it against your actual entry. And now after adding another quarter up here, maybe your actual theoretical average entry has moved down here. So your Theo average is now here. So now after coming up here, the market would have to go way down here just to get you out at break even. And so that's what a theoretical average entry is. It's as you move higher, your break even, and you book those profits, that break even moves farther and farther away, not just at your entry price, right? And so That theoretical average entry, by knowing that at all times, I think is part of advanced trade management. Because as you begin to scale and add and scale and add and defend and those types of things, your theoretical average entry starts going all behind you and you have no clue where your actual break even is. And when that starts to happen, things can break down. You don't know when your get out of dodge level is. You don't know when you're okay. It just becomes, you're almost trading blind. So whenever I have a trade where I've scaled heavily, I mean, I am the number one thing I'm doing is calculating that average entry in my head right away, writing it down on the paper next to me, right? I need to know it. And if you have something, like I said, like stage 5, it's doing it right there for you and analyzing that trade. And that's fantastic. That's what you want. Ideally, as traders, you want to be able to take some of that risk off the table as price moves in your favor. And that, again, as I mentioned, moves your theoretical average price against you. So that's how you're able to essentially, say a market runs up here, big time rally, and boom, hits resistance and drops. Okay, and then hits resistance again and drops, and then comes up in a little bit here, and then eventually, it drops, right? Well, each of these rotations here, what's happening here is, if you want to get short and you think something's about to happen here, you can get short on these rotations and book some profits and then add back and book profits and add back and build a position to where your actual theoretical average entry would be somewhere way up here after a series of rotations back and forth, back and forth. So instead of having an initial stop that was here, by booking some of those profits, you move that theoretical average entry way up here. That's why sometimes you'll see markets when they're doing this, boom, you see it do that because there's stops up there. It's not that someone said I'm going to get short and put a stop up here. It's because they've been building a position and their theoretical average entry goes higher and higher. And sometimes, obviously, that's where the stops are because you're trying to get a longer move down. We'll look at an example of that later on. So theoretical average entry is very, very important to be able to both calculate and understand, because you have to know where your break-even point is, especially when you're scaling, and that level will tell you whether you're able to add additional scales to your trade or whether your current scale that you're adding needs to be taken out at a certain level so that you don't take your trade from profitable to unprofitable. So there's various things that knowing this price in terms of benefit brings. So a good level to always know. That's right, Max. The theoretical average, in essence, avoids the stop hunting algos. And that's exactly true. I mean, it's because if you built a position like this, everyone knows the stops are here, right? But as you scale, your stop essentially comes way out here for a theoretical average entry. That's how I'm able to actually stay into some of these swing trades, because I manage it like a scalper, right? I get in like a scalper, and as it moves up, I've scaled like a scalper. So now, what if that trade actually turns out to be great by the end of the day and is a swing that I can hold? My entry is somewhere way beyond. I mean, my theoretical average entry is somewhere way below. And so now you can rest pretty and sit there and just say, you know what, I'm gonna let it go and turn this into a 2-month position trade. Or you could say, I'm going to turn this into a swing trade and look for the next 2 or 3 day move, but this can be applied in any time frame. Advanced trade management involves having a set of creative trade management techniques at the ready and understanding when and how to expertly deploy these techniques for a given situation or position. So here are a few of creative trade management techniques that I tend to use. Again, as I mentioned, these aren't techniques that you need to be able to use every single day. These are just techniques that when the right scenario arises, you know how to dust this technique off and execute it flawlessly within the scope of your bias, right? Execute your bias in the market. If you have a short bias, then execute that bias. And sometimes you have to create, some type of approach that helps you build a position to execute that bias. Or sometimes you need to be able to flip a position when you're wrong to take advantage of the upcoming momentum. So there's a lot of different types of creative trade management techniques out there. These are 5 that I think most traders should have in their tool bag, so to speak. The first one is defending a position or adding to a position. The second one is scaling into a position, which are partial entries. The third one is flipping a position. And the fourth one is building a position, and the fifth one is hedging a position. And each of these are going to be a nice brief introduction into each of these, but each of these in and of themselves can be their own, courses for the most part. Building a position or hedging a position by themselves can make your brain hurt by some of the hedging strategies that some of the quants use or some of the institutions use, or even what we used at our fund. I mean, it was head-scratching stuff, but it doesn't have to be that difficult. But what I'm doing here is mostly giving you the approach, giving you the idea, and then we'll work on additional ways to implement these as we move forward in Masters. So number one, defending a position or adding to a position, that's the number one first basic form of creative trade management that a trader needs to learn how to effectively use, right? So once you get into a trade, you need to know what the idea is for that trade. What are you looking for that trade to do? And then you're looking to anticipate ahead of what that trade is likely to do. You're looking to anticipate scales. Scales to first book some quick profits. You want to scale ahead of the first pullback. And then on the first pullback, you want to defend perhaps your trade using a portion of the position you just scaled perhaps. So there's a couple of ways to defend a position. The number one way that I like to use is adding back to the position after I have successfully scaled and booked some partial profits. So if price, for example, bounces off my level and goes up here and hits my T1, then I want to book before the first pullback. And on the first pullback, then depending upon how I feel about that trade so far, right here I can then add back whatever I took off over here. So if I took off half over here, I can add back half. Typically, if I take off half, I don't add back half. It just depends on the scenario. I usually add back a quarter, right? Something like that. And then when price rallies, I'll take that quarter off and keep the original half, right? So there's different ways, and we'll talk about some of those scenarios here as well in the charts. But defending a position is very, very important. You can either defend by adding back partial profits that you've already taken off the table, or you can defend a position by adding new money to that position if you really believe in it. So again, we can talk more about those in a bit. But this is important right here. Never add to a losing position. Never add to a losing position. Losers add to losers. That's what Paul Tudor Jones said. And I've kind of been part of this crowd where I've heard about different ways where you can average positions, and over time, if you have a large enough account, you may come out ahead, right? But man, that's tough. That's tough to go to sleep at night. It's tough to do that. It's tough to keep throwing money at something that's losing, right? That's just not an approach you want to do. So I have cautioned before that averaging down is a technique you can use, but you have to be skilled. You have to know what you're doing, and the folks that I've seen do that skillfully time and time again were those traders that had 30 plus years of floor trading experience. You have to do it with discipline. You have to know what you're doing, and oftentimes if you're averaging down, it has to be part of a plan, and we'll talk about that soon as well. Now, with regards to number two, scaling into a position, this is with regards to partial entries. So scaling into a position is the process of building a position by first testing the trade with smaller size. And once you do that and the position starts to pay for itself, and the position starts to work in your favor, then you add back. You add some or add to that trade. And perhaps you may, for example, if you want to have a three-part trade, you might enter a unit at a time. Enter one unit right away, test the waters, it starts to work out, so you defend with a second unit. That one starts to work out, you defend with a third unit, and now you're in the full position with 3 units. Something like that is how you would scale into a position. And I would say that based off the research that I've read, and I've done a lot of research based off of it, but based off the research I've seen and read over the last 10, 15 years, scaling into a position more often than not fared much better than actually averaging down and even scaling out. So that was something that I found very interesting, that scaling into a position, which was partially entering a trade instead of going all in on a trade, partially scaling into a position actually was a very viable approach against other scaling methods, because if that position hit its full stop, you were doing it on much smaller size than normal, right? Because if you're scaling in, again, if you're going to go half and half or a third, then you'd be stopping out at full stop with just a half a position or a third, whereas normally you'd be stopping out on a full 100% position. So that played a big factor, but scaling into a position is very viable. Although I don't do it as often, there are times, as I mentioned, there are times to be able to use it. Flipping a position is basically the process of fully exiting your current position while simultaneously executing a new position that flips your bias for a given market. And this approach should be used very sparingly, because it can be very simple to just hit that button at the top of your dome that says flip position. And then all of a sudden you flipped 40 times in about the last 10 minutes. That's not what you want to do. You want to use the flip a position when at those points in the chart where you know major momentum is about to come out, because the stops are about to get knocked out and you're part of that crowd. So if you happen to be part of the crowd that's about to get the stops knocked out, flipping a position at that point to take advantage of the major momentum move to come is a really viable strategy. It really is. And again, you don't want to use this strategy all the time, but during certain market environments or scenarios, it is fantastic. It's so powerful. And I would say that the major one is when passive participants fail to absorb a price level and then their stops get run. So when passive participants fail, it's a big deal. So if most of the time we're passive participants, right? We're looking for price to come to us, we're absorbing a level with limits, and then we're looking to run the stops of aggressive parties. So if passive participants have been absorbing a level over and over and that level gives out, it's a big move coming. So flipping a position during that time makes a lot of sense. There's also building a position. And this is one that I've been working more and more on, and this one has significant power. And this is one I've been working on, again, it's been a long time now, but this is an institutional technique. So, back in the day when I heard the terms floor trader and institutions, and when I heard certain words, algos, thinking, wow, I wish I knew the secrets that they had, right? So I always tried to really research what they were doing, whether there was mystique or not. Let's find the facts. And this was one of those techniques that I just believed in so much, because you see it in the market. It's the way that large institutions or big money players move big money at times. So building a position is basically the process of gradually increasing the size of your position, but doing so within a bracketed range so as not to disturb price. And usually you see that occur in distribution phases or accumulation phases, right? And this is a technique that, again, the larger big money players use, like institutions, to basically build a position and eventually for some sort of expansion that they've now built a position in to take advantage of that expansion. And this is a technique that not only institutions can use, but so can you and I. And we'll look at an example of that soon. And finally, number 5 is hedging a position. This one is super important. You have to be able to know how to hedge your positions during certain market environments and using different types of hedging tools. And like I mentioned before, you can do a whole dissertation on hedging a position in various types of ways. I want to just kind of introduce the topic, the concept, and just give you a basic approach, but you can do it in so many number of ways. Hedging a position is basically the process of creating a position in a correlated or anti-correlated product to counter the correction phase of your primary position. So for the most part, as I said, this is something that you would basically be doing here, where if price pushes down and you see some sort of longer term move coming, then when you position yourself here on those pullbacks, multi-day pullbacks perhaps, you can use, again, like I said, a correlated or anti-correlated product to sell during those pullbacks while keeping your existing position. So basically, this is a way hedging is a way for a lot of traders and even bigger funds and everyone to really counter the counter trend moves that happen in a trend while you're holding a larger position without having to focus on adding or defending the trade, right? So this is a way to do it without focusing on defending and adding. It's just a different technique, and hedging can be really powerful and pretty good. So what's the difference between 2 and 4? So that's a great question. And we'll actually, again, right now we're about to jump into the charts. But the difference between building a position and scaling, they're both building a position. But when I think of building a position, I also think of scaling as part of building. So for example, if you have a move that's gone down like this and then all of a sudden you see an accumulation range build, building a position to me, and we're going to see an example, is when an institution may buy X amount here, and when price comes up here, they sell X amount. Half perhaps. And then when price comes back, they buy X amount again and then sell half. And so you're constantly booking a little bit, booking and booking. So by the time price actually sees expansion and goes, your theoretical average entry is way down here. You're already up in the trade and price hasn't even broken out yet. That's building a position. Whereas scaling into a position is just one position where you're going to add a couple of points here and now you're good to go. So they're kind of the same. But I think building a position is more long-term, whereas scaling a position into a position can be more short-term oriented. All right, let's look at some examples now. All right, I'm going to come down here and I'm going to click on Advanced Trade Management. Okay, so we're going to start here on the right. And this is Advanced Trade Management, defending a position here. So this one is pretty basic, pretty standard, and most of you all know exactly what we're talking about with regards to defending a position, because this is something we talk about all the time. We talk about scaling, but with regards to scaling, our trade management techniques, we have the 11 technique, 21, 111, 211. We talk about scaling to protect profits, but we haven't talked much about how to defend or where to defend, right? And so that's what this is looking at right now. And defending a position is basically, as we mentioned, the process of adding to your current position after, hopefully, a scaling already. So you can add to a position anytime you like, but the way I go about it is that I do not add to a position until after I've successfully scaled first. I have to successfully scale at a T1 target first, and then if I feel good about that position and everything's turning out the way I like it, then I will perhaps defend that position. But by no means does every trade need to be a trade that requires defending it. This is active trade management where you're seeing something happen and you're like, wow, this one actually could turn out to be a huge move. So I'm going to look to defend it and squeeze a little more juice out of this lemon, right? And so that's when you would use a defense approach. And so what we're looking at right here is, for example, just say you get in right here. You enter right here on the short squeeze through these highs. So you're in, you buy 2 units, right? So we're basically using the 11 technique. You buy 2 units right here. And then the idea is you want to scale. You want your first scale to be ahead of the first pullback, okay? So when price pushes up, you want to be part of the first crowd to fill and get book some partial profits. That's what you want to do ideally. So if you buy 2 here and say this was 43.95s, and then price comes up somewhere in here, say 44.15s, you just made plus 20 ticks, right? You just made a plus 20 ticks there. So maybe you had a minus 20 ticks here. So this was your stop, right? Well, by taking half off the table now, you just made a plus 20 there. You only have 1 contract left, and this minus 20 now is offset. So if price comes all the way back to your stop, it's break even. So adding back, you can add back in a mathematical way, or you can add back in a price structure way, or ideally you do it both ways. So if price comes perfectly back to your entry, you can add back perfectly mathematically at the entry, add back that one contract, and now if price comes back against you, your risk is only half of what it would have been if it would have been hit, because you've already booked some profits up there, if that makes sense. And so right here in this instance, the idea is if you scale first, T1, and you scale, you're looking for price to come back and sit, right? So if you push through this high and you push through it a good distance, you're looking for price to come back and sit on prior resistance and turn it to support so that you can see another round of strength, right? It's the trending market. Trending market is lower highs and lower lows downward, right? And then you flip the market and now it's higher highs and higher lows, right? And so these higher lows step on top of these highs. That's just what happens. These lows step on these highs. And so those are defense areas. So each one of these here, let's go a little lower. Right here, that's a defense area, right? Here, that's a defense, but it goes a little lower too. It's not a perfect science, right? It's just those are the defense areas. So when you get into a trade, you want to get out at a T1 quickly, relieve that risk, and when price pulls back, you engage the market and defend by adding another unit back. So now you're back to 2 units right here. Here's the thing. Never add back or defend a trade if it means that the portion that you're adding back, if it fails and hits its stop, turns your trade from a winner to a loser. So don't defend if by adding back and losing money on that add back causes your trade to go from profitable to unprofitable. That is a no-no, right? So we never want to average down. We never want to add to losers, or we never want to add back if it's going to take a trade from profitable to unprofitable. So that's why knowing your theoretical average entry is very important. We never really talk about theoretical average entry before as much. I mean, I talk about it here and there, but it's because this topic is where it really starts to shine. And because once you start adding back, you need to know, okay, what's my theoretical average entry? Where is it at? And because if my stop is beyond that, and then now I've added back, and now I've just turned my winner into a loser, that's not the right way to go. So it has to be done the right way, and it has to be done with a mind toward risk and theoretical average entry. So defending the pullback, this is the first one. So if you're looking for some sort of trend to stop, this is the first part of what it looks like when it starts to turn around. And so if you're able to identify that low and able to get an entry in there and scale, you can then defend and then take that scale off when it comes up here. And then when price comes back, defend and take that scale off and just continue. So that's exactly what you would do. So you would just leave your original stop after the pullback entry. So what I do usually, and again, that's what I mean, you can add back price in terms of price structure, add back in terms of math. Math is knowing your theoretical average entry. So say right here, you got in long, boom, okay, and your stop was at 20 ticks or whatever, and you got it plus 20. When price comes back here, I would, if it's close to the entry, I would hold the original just to keep it, like I said, math. But oftentimes, what I do is almost use that scale as its own little mini trade within the overall trade. So this one, I may attach its own 10 tick stop, and so if it goes up 10 ticks, I'll just take that off, plus 10, and just scalp that little bit. So that's what I will do sometimes. There's various ways. Again, active trade management means that there are so many different ways of doing things because you have flexibility in your approach, and that flexibility gives you can do anything. And that's what's cool, but that's also you got to build your approach. So on typical trades, if I add back, as soon as it goes up and swings higher here, I'm taking that add back off and I'm taking that little bit. And if price comes back again and I add again, then I'm taking off that little bit. Meanwhile, I'm just holding on to that other one that I got in originally, and I'm just letting it play on, right? Advancing the base runner. Base hits, and this one right here is rounding third and going home. So that's what, kind of defending is all about, is being able to be part of the development of the pattern, right? because that's what everybody else is doing. That's what is happening. That is the market. The market pushes back through a pivot high. So when it comes back to that pivot high, passive buyers, responsive buyers, they want to come in, they want to defend and absorb and then squeeze. And so that's what you should be doing. It's just understanding where those points are sometimes can be hard, because look, they faked it here, then they went down. They faked it here and they went down. And that's where it comes down to knowing what the general rhythm is of the market. That's why you always see me trying to figure out what the signature is of the market. And once you get a distinct signature, you can you can kind of expect what size rotations to be expecting. That's why I said before, okay, right now we're seeing rotations of X amount, and now, this rotation doesn't fall in that category, so you're not going to defend until you see a rotation of about X amount, right? So you're not going to fall for this because you want to get the actual rotation and then try it. And that's why you usually see me counting out points and rotations, and that's what we were doing in the premium trading room just yesterday. And it worked out nicely. So a lot of different flexibility that you can have here, but the main thing is you never have to defend a trade. It's just when you think things are working out nicely, defend one. But take back that unit off the table pretty quickly and just use it as a mini scalp if you want. Or you can add it and keep it to the table if you're looking to do a longer term type of position. But you just don't want that add back to ever cause your trade to go from profitable to unprofitable. And that's really where rule number 1 comes into play, which is don't add back unless you've scaled first. They kind of go hand in hand almost. So scaling into a position. So there's 2 forms of scaling into a position, and we're going to mostly mention this one here, and we'll talk a little bit about the second one. But scaling into a position, again, is the process of building a position by first testing the trade with smaller size, perhaps half a position, and then adding to the position should it begin to work in your favor. The idea is to add to winners, not to losers. And so scaling into a trade would be like saying, okay, the market's been dropping this entire time. I want to do a 3-unit trade, but I want to be sure that this thing is holding. So instead of getting in 3 units, I'm going to get into 1 unit right away. So I'm going to use that squeeze entry, and I'm going to buy 1 unit. And then price goes up nicely. And you're like, oh yeah, that worked out nicely. So when it comes back, I'm going to defend and add back, or add a unit. So now I'm in 2 units. So now you're in 2 after the add back. And then that one works out, and you're like, okay, great. I'm going to get into my 3rd unit now on the next pullback, and now I'm in 3 full units. And it averages down a little bit, but you're in those units now in a different manner here. So you're scaling in, and you're forcing the market to kind of prove that it can continue to play out in your favor and kind of prove that it's going to be a winner. So you're kind of slow playing your entry. And there's different ways to scale into a trade. Different ways. A lot of times, instead of going just 1, 1, 1, for me, it's better to scale in going something like a 2, 3, 4, something like that. This is just a basic idea. Typically, if I'm scaling into a trade, if I want to do like a 211, then I may go something like 2, half of the 4 units. So I might go 2 units, go long. So instead here, buy 2 units. And then when price gets up here, scale, right? So you scale 1 unit, 1 unit. And so when price comes back, then you're adding 2 units here. So that brings you up to 4 units, but after you've scaled. Or sorry, you're adding back 3 units to make it 4. 3 because you just scaled. If that makes sense. So it's basically getting it just depends on how many units you want to complete, and also how and when you want to execute those units. Scaling into a trade has its advantages. I'm not usually one to scale in fully like this. I'm not usually one to go all the way and just say keep scaling. But I will add and defend positions like this as well. I think that the biggest one that I would use, like I said before, if I'm going to go for a full 4-unit entry here, if I'm scaling in, I'll go 2 right here, and then I'll scale half right here, and then when price comes back, perhaps you pick up those next 3 to go to a full 4, right? And so you're doing something like that. And so again, it's just a creative mix, and you'll find your mix as well. But the idea is when you use this creative form of trade management where you're adding back and scaling, the idea, again, you have to mind your theoretical average entry. It's not just about, hey, I'm long here and then I'm going to try here and see what happens. It's if you do get X amount of points up here, what does that mean to the stop? And then what does that mean for where you should enter the next trade and how much risk you can give it, right? So there's a lot of little math that goes on in the background. That's why I'm saying when you have to deploy some of these techniques, you have to have already practiced it, because you can't start doing this math right now in the middle of a trade. You just have to know what's going on and how you want to do it and what that means for the theoretical average entry. But the other approach to scaling into a position is something I call the carpet bomb approach. I don't use that approach all the time, and I've tried it with varying degrees of success over time, but I think that our precision entries in here and the way we do things affords us the ability to not have to carpet bomb at level. And so carpet bombing would be, and you see this a lot with floor traders, carpet bombing would be basically saying, I don't know where price is going to turn. I think it might turn somewhere, just say 43.90. I think it's going to turn somewhere around 43.90. So what I'm going to do is I'm going to buy one right here at 43.90. If price goes down to 85, then I'll buy another one. And if price goes down to 80, I'll buy one more, right? So you basically carpet bomb the levels. You put one scale here, one scale here, one scale here. And so when price comes down, it'll trigger 1, it'll trigger 2, and it'll trigger 3, and now you're in a full 3 contract or 3 unit trade. So carpet bombing a zone, scaling into it. And you'd see a lot of floor traders do that all the time. And some of them do it really well. The idea with that one, though, sometimes is that if, for example, if say you were carpet bombing like this level, and this level, if price only fills 1 and 2 and doesn't fill the third, then you don't get that full position. But that's okay, right? So that's another way of scaling into trades, but I don't always use that technique, and I haven't always fully had success with it all the way. And so I want to let you know that technique is one that's there as well, but it requires some practice because, again, we are able to identify some pretty good, accurate areas for rejection sometimes that we don't need to carpet bomb an area. We can just watch the order flow and get a pretty good confirmed entry without one. And so that's another approach that you can use as well. So here's building a position. Building a position is one of these approaches that, man, if you are able to line it up at the right time, you can really clean house, because this is an approach that the larger funds or the institutions would use at any one of these points in time where the market is in a congestion range, either at highs or lows, accumulation or distribution. And it goes back to the time when, and it is still that time, basically, if you want to buy 100,000 shares of a stock, or maybe you want to buy 2 million shares of a stock, you can't do it all at the same time. You have to be able to, do some at one level and just do it within a bracketed range, right? So back in the day, again, building a position, if at an institution they say, hey, we got to sell the ES and because we believe a larger correction is coming. So let's gradually build a position of, say, 10,000 contracts, right? So instead of selling 10,000 contracts here, they might sell 2,000. Let's sell 2K. And then when price drops, let's buy back 1K, right? So here's a basic 2-to-1 type of scenario. So you buy 2 units here, or sell 2 units to start a short, and then price drops. And then down here somewhere at the bottom of the range, you buy back 1 unit. So you're basically taking half off the trade and you're making X amount of points. So when price comes back toward the area where it's being absorbed, you sell another 2 units. You sell another 2 units, and when price drops to the bottom of the range, you buy another unit. And so when price rallies again, wherever it comes back to, you sell 2 more units. In this case, it was right here off of 2061s, the HVN, and they started absorbing from below. And then when price drops away from there, again, it says buy 500, but it's buy 1 unit. And then when price comes back up, this is another point here where you sell 2, right? And so when price comes back and you are starting to see that expansion may come, now this is where they pull the demand. They pull the demand. They don't buy again down here. They don't buy. They pull it, and that creates excess supply, and that's what leads to the big drop. And so this is something that you would see over and over again at various points in the chart. So I need to fix this one and re-upload it because that's kind of confusing. But so don't look at that number right there. It's supposed to say 1. So right here, again, just say you sold 2 and then you covered 1. Sold 2, covered 1. Sold 2, covered 1. Sold 2, covered 1. So that was 8 contracts here, right, or 8 units. And over here you took care of 3, so that you have 5 units now. And so think about it. If you sold 2 units here and you take 1 off the table down here for a gain, what's your theoretical average entry on that 1 contract now, or that 1 unit? You know, if you made money and say it was 77.5 to say 2,000, let's call it 80 points. That's $4,000 per contract. So if you sold 1 unit or 2 units and then you buy back 1 unit, you just made a plus 4K on that 1 unit, plus 4K. So that means that from this entry price, you can put your stop 80 points above because you just made it on the bottom. Okay? So now when price bounces again, you come in here again and attack the level and sell 2 more. So when price comes down, you buy back that 1, and now you just made another plus 4K and 80 tick or 80 handles on that 1. So now you're adding, 80 plus 80 up here. And you do that over and over and over again. So you can see that over time, by the time this thing is breaking and the demand is pulled, and you see the excess supply leads to a downward price discovery phase, then by that time happens, you've already bought 8 or sold 8, you've bought back 3, so now you're left with 5 free and clear units. So all of this is nothing but money, and your theoretical average entry is somewhere astronomically high. It's way up there. Their theoretical average entry is probably 2250 in this example. I mean, something significant. It's just giant. And so all of this right here is free and clear. Because even if this market had done this, you're still in the money because you've booked it first, and you can withstand a little pullback. That's how some of those larger positions are able to be created in these markets ahead of big turning points. Instead, it's not just saying, "Ooh, I caught the top here and I got short and made this." Sometimes they're making all this first and this as they build into it. And so building a position, again, if you're able to identify one of those major points in the chart, and it doesn't have to be higher time frame, it could be lower time frame as well, because that's what's happening down here. On these absorption signatures, they're building positions down here on that little right side, and then you see the explosion. And so that's where I really started to fine-tune this approach, was intraday off these absorption signatures. And I started doing that several years ago, probably 3 to 4 years ago, where I started noticing a lot of signatures like this over and over again. And I drop into the intraday time frame and just watch it do this and do this and do this, and eventually, boom, by the end of the day it was here, or by the next morning you woke up and it was here, and they absorbed off of here. Rotation after rotation after rotation, building, and pow. And so this approach can be super powerful. And the reason I attached it to this particular example is because this is the ES. And back then, the ES, if you recall, it was failing to hold above the August high. So it's failing to hold, and that implies a rejection. Then it comes back up and it's failing to hold, implies rejection. Then it comes up and it can't even get up there anymore, and it's rejecting off of value from below and is being absorbed. And so if you recall, back during this time, this is when I was saying I think this is headed to 1800. I think it's headed to 1800 because it's failing here. It's failing. It's failing. Now this is going offered. Watch out, right? And so when you have that inclination and you believe that can play out, you start to execute that bias and you build a position over time. You build that position. Now, of course, there's some contracts that expire during this time, so it's more of an example than an actual, holding a contract from November to January. But it's more about the idea. If this is a stock, it's the same thing. If this is an ETF, it's the same thing. So, this is one where overnight can get very volatile, so stops have to be lenient. That's a great question right there. This is a specific ES futures contract, so things can get hairy on you. The idea is more being able to enter these trades using our basic trade management approach that we always use. So our core trade management approaches. I always mention that I enter a trade like a scalper, right? And then I let it graduate to a swing or position trade. So at these specific entry points up here, while most institutions who build these types of positions may not be looking for as precise entries, we have the ability to go in there and be much more nimble. So I would say that when you're building these, still use your scaling approaches to kind of actively manage that risk right away so you get to break even fast in the trade. And then from there, by the end of the day, hopefully you've built enough to have your approach against you. So sometimes, sometimes in order to have 2 units and bring 2 units down here, you may have to execute 4 up here and then take half off the table by the end of the day so that you've covered that risk for overnight. And then you hold those 2 down here and take 1 off. So there's a lot of, again, there's flexibility. As many different colors of ice cream that you can make, that's the same thing here. I mean, there's so many different flavors of what you can do and how creative you can be in building these approaches. But that's what I mentioned before. We can get into more scenarios as well. This is the base framework to help you identify that. But I would ask each one of you to go back and look at some scenarios where this type of approach kind of played out and look at the rotations and do the money math behind it. If you buy 2 units in here and then you sell half up here, then you come back and absorb and buy more units, by the time price plays out and works in your favor as you expected, how much more money would you have made? How much less risk would you have taken on than if you would have just bought and hold, right? And so that's the idea. If we just bought and hold or sold and held, you're holding on more risk and all of that instead of having a more active approach where you're able to kind of reduce that risk and also book some profits in the meantime, right? And so that's why I said before, most of your trades will be static core trade management techniques. But there are times, again, where you would want to use these techniques like building a position where it can really pay off. This is one of those circumstances in the market where I couldn't have said it any plainer for 2 months that we were rotating lower, and eventually we did. And so if you're able to anticipate that type of market event, build a position heading into it, you can profit from it much more significantly than if you would have just engaged the one decline ahead. And you would have mitigated risk much better as well. This is flipping a position. So flipping a position, as I mentioned before, flipping a position is the process of fully exiting your current position while simultaneously executing a new position that flips your bias for a given market. So, for example, maybe you're long, in a certain stock or something, and the stops come out, and then the price goes way against you. Well, if it's one of those circumstances where you know that if the stops come out, the thing's about to be big, then those are one of those circumstances where you can flip your position. And again, I would caution that this approach should be used sparingly. While it has its advantages, I think traders can get very used to just clicking the flip the trade or flip the position button, and then all of a sudden you're just racking up extra commissions for your broker and getting whipsawed in your trades. So this isn't one of those types of strategies that you want to employ every single day. It's one of those ones where when there's a certain scenario that lines up and you happen to be getting caught in perhaps a stop run, then that would be one of those times where you would use this approach. So it starts off by, for example, if you recall here, we had our big time reversal from these lows, and this was the NQ, and price rallies right back to resistance here, right back to resistance. And then we saw this rejection tail form, and I thought, whoa, that rejection tail just formed right here. That's curious. So I said, okay, now this could lead us back to, at least back to support or somewhere, right? And so I said, this might be a spot right here where you want to defend the midpoint of that and get short. So if you see some sort of absorption signature developing, for example, that's where passive sellers, in this case, a bearish absorption signature has passive sellers that are in here, and they're selling. And price dropped, and you saw what happened, right? Well, then I said before, remember, this is the one where I said that the last line of defense is 1921s in the ES, and this was the day where price came down, hit just below the previous low, and then a massive squeeze happened. Massive squeeze through these highs, causing a failed absorption signature and leading to a massive squeeze. Well, it may have been very apparent that these passive sellers were going to get squeezed at that point. Sometimes it's very apparent. So if your stops are right there with theirs and you know that it's about to get run, then this is a point where you can flip that bias and take advantage of the momentum that's coming in the opposite direction. So it's mostly on those times when you want to flip a position, it's when there's a major run on stops coming, a major run on stops. And the major means that you need to be waiting for passive participants, and more likely you'd like OTF passive participants. So when OTF passive participants fail to absorb a price level, a major momentum move can be seen when the stops come out. This is an ideal time to flip your bias and your position should you get trapped with the crowd. And so again, you can see there's certain times in here where prices just aren't working, and then price pushes up. Another time where this would be good, where you want to flip a position, is say price is dropping, and here's the previous week's low, for example, and prices are holding, and you're short, you're trying to defend right here, and it's holding, and all of a sudden you see a box forming. And you're like, uh-oh. And your stop is right here with everyone else's. Well, when price comes up, right, this is a spot where you can flip your position, and now this thing rallies off. We've seen that happen a lot, right? So flipping your position is a great approach. You have to use it sparingly, but it has its scenarios where it works. Major stop runs is where it works. So OTF participants, or perhaps failed trapped participants, right? So beyond the previous week's low, for example, trapped, boom, right? So this is the spot to flip if you're short, or you just get long, right? So flipping a position has its advantages, but you can't just get used to doing it all the time. And hedging a position. So this is the final chart that we're going to be looking at. Hedging a position is the process of creating a position in a correlated or anti-correlated market to counter the correction phase of your primary position. And so you recall this is the absorption signature that we were looking at before. So this is something that I started to use on a swing basis because I was enduring some significant pullbacks to get larger moves. And I actually developed this with regards to the NQ before because I had been big time long the NQ. So for example, I'll show you what happened. This was long before when I created the approach or needed the approach in my arsenal. But basically it was something like, hey, I got long. Actually, I got long at like a low. And then we saw this big old move. And then I was like, you know what? This thing is going up to here. So I'm just going to hold the pullback, until we get back. And I just watched it come all the way back, right? Now, it wasn't in this exact scenario, but it was one of those where it came back 100 plus points against me, but I was up 200 plus points in the trade, right? And during that, and then I was like, that's just got, that's dumb. I should have been hedged. And so during that pullback phase, the idea is to hedge your primary position with a correlated or anti-correlated product to counteract that drawdown. So basically in this case right here, you can see here's the absorption signature that we talked about before. When we hit that low and we failed to hold below 1800s and popped back above support, we talked about watching this area right here for a squeeze, right? So say you did partake in that and you got long somewhere in here. So you trigger a buy position in the ES due to that absorption signature and price rallies. You're like, yeah. Well, at some point, you know that once price goes up, it's got to pull back in order to energize and go back up. So when price comes up here and on the first day where you start to see weakness above the previous session's high, that's a time where you can go to a correlated asset or correlated product like the NQ. And so this was the same NQ move right here that we're seeing. And say you're long the ES, but on this day and this day, you get short the NQ. And now boom, boom, you're short the NQ on that little pullback, right? So you basically counteract it. So it allows you to stay long your primary position, but it offsets some of that that drawdown because you're actually short and going against your primary position, but only short term. And then you turn off that correlation, and when things starts working out in the proper direction. So that's the primary idea, right? When you get long and you're looking to hold for a day or two or three or longer, and instead of enduring those pullbacks that are inevitable at times, you get into a correlated asset or anti-correlated, as I say, and take advantage of that counter trend move by shorting that asset. Now, if I mentioned correlated because the NQ and the ES are seen as correlated for the most part. Now, they can become more anti-correlated at times, but for the most part, they're correlated assets. If the NQ is up, usually ES is up, right? You can also use, if you're trading ES, then you can use the SPY. You can use options to hedge, right? So you can use so many different things to hedge a position. It doesn't have to be future to future. You can also say, hey, if I'm in the ES and I'm long, when price starts to go, when this counter trend move starts happening, you can buy an anti-correlated product like a bond. So if the ES starts to pull back, buy bonds, right? And so now you're buying bonds to counteract the pullback in the ES, to hedge it, right? So there's so many different ways to hedge a position. I use Dust to hedge GDX. Ah, cool. One thing that I will say though, and this is what I mentioned in the slide, is that hedging a position requires understanding how to balance a hedged position, right? And that can be difficult at times because of the market's constant change of volatility. So what I mean by that is, if you go long the ES, right, and then you're looking to counteract this, you want to counteract with the NQ. But if the ES pulls back, say 30 handles, what does that mean for the NQ? It might be 75 handles, right? And depending upon what the price structure is for each, what each pays at each one, you want to make sure that you have enough balance between the two positions. So if you have 50 grand in the ES or whatever, and you want 50 grand in the NQ, perhaps, right, on the counter trend, so that on the counter trend move, it's correlated, right? You don't want to be overdone. You don't want to be, overhedged or anything like that. But it changes. So you can hedge yourself, like I said. You can have this. You can do a whole dissertation on this. But what we did when we were doing this with the managed fund was that we had kind of a spreadsheet, and it included lots of different details, including current volatility, including current margin for that particular futures product, including other metrics, and it came up with a scale. So when we wanted to hedge our ES trade, and say we were long ES and we wanted to hedge with the NQ, then we knew that for every 4 ES contracts that we were using, we wanted to hedge with 5 NQ contracts, right? But then over time, due to the data and due to the volatility, due to the margin changes, due to all those things, maybe 3 months later, the correlation is now 2 and 3, right? So we had these correlations that we did, and we would say, okay, if I wanted to hedge with this, then I need to use this amount. So anytime I wanted to trade, the TF and go long, and then I want to counteract it with, a short, then I needed to know what the TF translated to the ES, And so we did that. And so that's something that you can do as well. You just have to know how to balance your trade. You don't want to be over hedged, and you don't want to be under hedged. So if, for example, if this move in the ES right now, this pullback is going to cost you, say, $2,000, then the hedge, should it be in the money, needs to be up about $2,000. If it's only up, $500, then you didn't hedge enough. If it's up, $5,000, you hedge too much, and you need to watch out because the primary direction's up, and if that position starts to get squeezed, now you're hurting yourself. So you just have to know how to balance the hedge in the right way. And again, doesn't have to be super fancy. It can be as simple as you want it, and you can be as difficult or complex as you want it. And with regards to hedging, my simple approach is just that if I'm long the ES, I was going to be long anyways. So on a days where I know that the market's likely to pull back, and those days, because it goes up in pre-market, it tries the high, it starts to fail. So after a big expansion day, you might have a pullback digestion day. So sell it. That's it. You just sell, and then you close it out at the end of the day. The next day you sell, you close it out at the end of the day, or whatever. It can be very simple. So we would initiate these, in the morning and take it off in the afternoon, that type of thing. Do you also hedge a position in SP 500 with the VIX or the inverse VIX? I suppose you could, absolutely. It's not something I've done, or at least not in a long time, but you can definitely do that. And what we did before, again, I told you this before, that I had correlation. We had a platform that allowed us to do correlation studies on everything, on anything. And so we could see what the correlation was down to, the millithousands. I mean, it was down to the lowest decimal, where we could see that the ES was super correlated with these products, or these other charts, or the CL was super correlated with this or that. So we were able to go in there and see what was correlated, and from there we could build a plan for it. So if the VIX happened to be greatly correlated with the S&P 500 with regards to being able to hedge it and trade a vehicle that allows us to do that, then that's how you go about figuring out if that's good or not. Is it correlated? And if so, how much do I need to balance that trade, and is it a viable option? And that's pretty much it. So it can be as simple as you want it to be, or it can be very difficult. Again, you can do it with options, you can do it with futures, but the idea is, more and more, as I play higher and higher time frames, like I said, sometimes I get these great entries on the lows and I get into some big move, but then I just feel like I'm a sitting duck when this thing is going backwards when I should be actively doing so. So that's the other thing, is that when I mention it can be as easy as possible, it's that if you're swing long in one account and this thing's going up, on the counter trend days in a different active account, you could be aggressively shorting only during those days. So only short trades here while this position's up to counteract, right? And so there's so many different ways to hedge, as I mentioned, and you'll come across more and more of these ways. We'll talk more and more about them in Masters as well. This is primarily for larger swing position trading. I would say yes, it's more for longer term duration type trades, but it can be done intraday as well. But just, for the most part, it's if I think, for example, if I think intraday, the NQ is going to be up here by the end of the day, but in the meantime, you may see rotations, then you could be selling the ES during those rotations while keeping the NQ long by the end of the day. So you can do this approach intraday as well, and it requires it's basic. It's just the basic idea of hedging, not how to hedge. There's so many different ways to hedge. It's just the basic idea. So again, if you're long on the NQ during the day and you think it's going to be higher by the end of the day, you just have to wait 6 hours. Then on any counter trend rotation or significant counter trend rotations, you can be trading the ES short, to counteract those counter trend moves. Hedge core positions, absolutely. Hedge core positions. That's what it comes down to. I call it a primary position, the core position. Hedge the core ones. Hedge the ones that you want to push to the finish line, right? The ones that you want, 1800 and 2061. But this can be difficult sometimes. Actually, this was a perfect trend for it. But sometimes it can be a lot hairier than that. And during those times where it gets hairy, just know how to hedge those times. Oh, cool, Tom. MD contains a correlation coefficient indicator. I'm gonna have to check that out too. Yeah, correlation is really cool. I do miss. I have to admit, I miss some of my correlation tools. Actually, I have them back now, so time to start tinkering and getting back on it. And I want to incorporate some more of that in our rooms as well. So that's pretty much it for the hedging portion right there. So that pretty much does it for the advanced trade management portion here for Pivot Boss Masters, which is under the core training execution portion of our training. Advanced trade management, as I mentioned before, is nothing more than the ability to expertly and skillfully execute your bias in the market in any time frame, using advanced creative types of trade management techniques. You also have to keep your eye, as I mentioned before, on that theoretical average entry price. That's super important because knowing that price gives you the heads up whether you can scale at a certain area, whether you should defend at a certain area, or where your average entry is once you've built a position. So understanding all these various little components and then starting to mix them into your game can be a lot of fun, but it takes a lot of practice as well. The first time that you're looking to build a position shouldn't be the first time you're calculating those numbers and figuring out what you should do. You should have already practiced that by now and then be able to implement it and deploy that technique once it comes. With defending a strategy, practice it, visualize it as a market is moving. Even if you're not engaging it in that way right away, do some mental reps, right? Mental reps on the sideline. As price pushes higher, say, okay, if this would be a spot right here where I would scale, and then right here is an area that, according to the price structure, passive buyers are going to want to defend that pullback. And then when price does it, you see it happens, and then you're like, oh, well, that worked out nicely. Okay, well, and you start to do more and more of those mental reps, you start to really see the opportunities develop much, much better, much cleaner, much easier, and then you're able to engage those opportunities. As I mentioned before, the majority of your trades are going to be the standard, static, core trade management techniques. The 11, the 21, the 111, the 211, those are your core techniques that, for the most part, you want to just deploy and let them go. But there are times in the market where you need to get creative. You need to know and understand when to kind of divert from the plan and start executing more of an active trade management approach, and that's really what this session was about. Just exploring the types of ways that you can creatively enter or exit a market, and then looking to put all those building blocks together in the market when the actual scenario presents itself. So I hope you enjoyed our advanced trade management techniques for Pivot Boss Masters and core training, and I look forward to seeing you soon.